want your real GDP to grow at 9 or 10%, frankly, if we want to become a developed country. It's a reality check moment for Indian economy. Hello and welcome to the Indian Express. As many of you might know, the Indian government has come out with the first advanced estimates of India's GDP. Now let's just unpack what exactly is the first advanced estimates. The gross domestic product or GDP is basically the market value of all the goods and services that are produced within India, and it's the economic output of the country in a particular financial year. It also determines the size of the economy. And for the current financial year, India financial year runs from April to March. So for the current financial year, which is currently underway, the government has come out with the first advanced estimates. Now, these are essentially a forecast of what the economy is going to be by the end of March. So even though the year has not ended, the financial year has not ended, the government does some calculations. It looks at the existing data that it has for the first 7-8 months. It also looks at the trends that it has from past years, and it uses them to extrapolate, to calculate what might be the end value by March end. And according to that, it makes these projections. And typically, these projections do get updated, sometimes substantially. And they come out as second advanced estimates and provisional estimates. And these revisions continue happening for a few years, actually, before we come to the final figures for a particular year. By that time, most people have forgotten about it, but the calculation continues happening. However, for the time being, the first advanced estimates of GDP have come out. And according to that, the government expects India's GDP to rise by 9.7% in nominal terms and 6.4% in real terms. The difference between real GDP and nominal GDP is the inflation bit. So typically, when we spend money under normal circumstances, that gives you the value of nominal GDP. But when we take away the inflation aspect of it, then we get the real GDP. Real GDP essentially tells you what really has been the incremental impact of one more year. Have we produced more goods and services in real terms? Nominal GDP tells you both the effect of more goods and services as well as the effect of prices. Now, the important thing is that nominal GDP has come out as 324 lakh crores. Lakh crore can be abbreviated to trillion. So 324 trillion. And if you look at the dollar rupee exchange rate and divide it by that, so suppose you take 85, then that turns out to be $3.8 trillion. And that becomes the size of Indian economy in a global setting. It is interesting to note that if the exchange rate, because we have talked so much about a 5 trillion economy and there's so much talk about exchange rates, if the exchange rate was 61, which was the exchange rate when Prime Minister Modi first took office in 2014, then today at the same nominal GDP of 324 trillion, we would have become a 5 trillion economy. We would have breached that mark and become the 5.3 trillion economy. Anyway, considering that the exchange rate is 85, we are now at a 3.8 trillion economy. And that shows you how sort of exchange rate also affects how big a size we are in a global context. Now, this nominal GDP has come out to be lower than, at 324 trillion, has come out to be lower than what the government estimated it to be in February last year when it was presenting the interim budget, and in July last year when it was presenting the full budget for the current financial year. In February, it thought to be 328 lakh crores, 328 trillion. And in July, it rolled it back to 326. And now the first advanced estimates say that it might be 324 trillion. We'll have to wait for provisional estimates, which come out maybe in May, to know the closest figure that we'll get to know. In terms of real GDP, which really matters to all of us when we talk about GDP growth, the GDP growth has been 6.4 for this current financial year. But the most important thing, the most important takeaway from these GDP numbers is that if you look back at a longer period, say over 5 years, 6 year, 10-year period, then we find that real GDP in India has grown at less than 6% annually since 2014. And even worse, this number has further come down, and real GDP has grown by less than 5% since 2019. When I say 2019, it's the year before COVID. So it's very important to understand that while India has had some fantastic growth numbers in the last 2, 3 years after COVID, the reason why, or a big reason why that happened, is because there was a contraction in the COVID year, that was 2020-21, and that contraction provided the sort of statistical illusion of high growth. But if you look at a longer period, over 6 years since 2019, then our growth has been less than 5%. And this is roughly half of what you would want your real GDP to grow at. You want your real GDP to grow at 9 or 10%, frankly, if we want to become a developed country. So the first thing to understand is that it's a reality check moment for Indian economy. It is important to understand that uh, while on the face of it, we are growing very fast in terms of GDP growth, if you take a longer period, the growth is far more moderate. In fact, it's seriously slow, and which should create concerns for policymakers. Now, the question is, why is India's growth so slow? And there we have done in the piece that I've written for the Indian Express, we've looked at the data, and we find that, if you look at the four main engines of growth, we have the biggest engine of growth, the biggest engine or the factor that leads to higher GDP is the spending that you and I do in our private capacity as individuals. So what Indians spend in their individual capacity is the biggest engine of growth. It accounts for 60% of our GDP comes from that. And that engine, which is called the private final consumption expenditure, it's a complicated acronym, but that engine is essentially growing at 4.8% annually since 2019. So it's growing at less than 5%. And even if we were to go back to 2014, then it's growing at less than 6%. So the biggest engine of growth, which is private consumption, is actually growing at a very weak level on an average basis. And this is why you hear so many stories about cars not being sold, or not, there being massive inventory of different commodities, FMCG companies saying we are not selling enough, we are having distress here or there. This is the reason. The second biggest engine of growth is the money that governments and businesses, more businesses, put towards boosting investment capacity, productive capacity in the economy. So typically what happens is that when people demand a lot of goods and services, companies think it's a great time to invest, boost productive capacity, they invest money in that. So that spending then adds to 30% of India's GDP. But even that number has been growing at just 5.3% over the last 5, 6 years. So that's again a very weak number. And this is happening despite government giving corporate tax cuts, which are historic. And we've heard the finance minister being agitated that not enough is happening on the private sector front, that they are not really investing more. And they're not investing more primarily because the biggest engine of growth, which is us, as in our individual capacity, are not spending much. Then the third engine of growth is government spending. What government spends in terms of salaries or daily expenses, that's around 10, 11% of adds to GDP. And that also has been growing very weak, just 3.1% on an average level since 2019-20. That's just a year before COVID. And just, I mean, it's important to take the year before COVID because that tells you the story over a longer period. Post COVID, you only see a recovery without realizing what happened, what led to that recovery. So the upshot of the latest GDP numbers is that it provides a reality check for policymakers and citizens alike. it is important to understand how are we growing at an average level, and that number is less than 5. At less than 5% average annual growth, India will struggle to create jobs, prosperity, equality, for its citizens. So once you see it in that light, you will understand that actually it is not a surprise that not enough jobs are getting created, either in the government sector or outside. And then it sort of explains why there is considerable economic distress. And that sets the platform now for the union budget, which will be presented on the 1st of February. All eyes are now on how Finance Minister Nirmala Sitharaman reacts to this situation. Growth is slowing down. Inflation continues to be persistently high, even if maybe not higher than what RBI has a comfort zone on, but still remains persistently high. And private sector is not investing. Private individuals are not consuming as much. So what can the budget do to restart the whole cycle? Thanks a lot for watching the Indian Express. Stay tuned.